we're not buying anybody's business. We're supporting the management team to deliver their plan. There's the question, isn't it? Is the what exactly is it that you guys do?
What are the downsides for a private company taking private equity?
It's absolutely exploded. There's so much more money looking to invest in UK businesses, and that's awesome. We see about 1,600 opportunities a year, and we're trying to do a dozen or so. I'm most sad for the team that put 10 years into it, sort of come out the other end was nothing.
This is the Leeds Business Podcast, and I'm your host, Phil Fraser. This week, we speak to Jamie Roberts, Chief Investment Officer at YFM Equity Partners. I took the opportunity to ask Jamie everything we all need to know about taking private equity in our businesses. Even if you're not looking at inward investment right now, there's tons of great stuff in here, including what private equity houses actually look for, where the power really lies, and the importance of doing your own due diligence on any potential investment partner. Before we start, I have one simple request. Please hit the follow or subscribe button on the app that you're listening on. That's it. Thank you. Okay, so let's get into what is a really educational episode. Today on the Leeds Business Podcast, I have with me Jamie Roberts, Chief Investment Officer of YFM. Good afternoon, Jamie.
Hi, Phil.
Great to have you on. Now, for those of you who've been listening regularly, you might recognise the name YFM because they've been currently sponsoring the podcast. So rather than me doing the sponsorship read today, Jamie's going to do it. So Jamie, give us 30 seconds on YFM.
Thanks, Phil. YFM, a private equity investor in the UK, offices in Leeds, Manchester, Birmingham, Reading, and London. And we're investing £3 to £15 million into businesses based here, operations abroad, but headquartered in the UK, looking to do interesting things and create value for their stakeholders. We've been doing it for a long time. So founded in Leeds 42 years ago. So we've been around investing in great businesses for decades.
Okay, great stuff. And the one thing you didn't say, Jamie, is where people can find more information. They can find more information at yfmep.com. The link to that is in the show notes below. And when you do contact YFM, tell them that Phil from Leeds Business Podcast sent you, because then I get a bit of kudos and they think their sponsorship's working. So let's start right at the top, Jamie. What is private equity?
Different types of private equity, but broadly, private equity is non-listed money. So listed is stock exchange stuff. So public, what would be called public markets. So anyone can buy and sell those shares on a daily basis when the markets are open. Private equity is capital, but they're in vehicles they're not open to everybody. So people invest in a fund. Traditionally, that fund's probably a 10 to 12 year life fund. They put their money in at the beginning and then they get their money out at the end.
Okay, so you have private investors putting their money in a pot with you that then you go and invest in the businesses you think are going to be successful.
Yes, yeah. So they're backing our judgment. So they put the money, it's still their money, obviously still their investment. That goes into a vehicle. We use that vehicle to, one half of our business is backing management buyouts, cash out deals. So what we think about as replacement capital. So money that's going out of the business. And then we have an equity stake in that business going forward. And then the other half of our business is growth capital. So money going into the business to fund growth, mostly job creation.
Okay. That actually leads to the next question I was going to ask. So how would a company benefit from taking private equity?
I put it into two buckets. So the first thing, the obvious one, is it benefits from private equity because it benefits from the money. So it could be that that money's going into the business and it's going to help the business grow faster. And they're going to use that money for recruiting great people into the sales team, recruiting great people into R&D, buying assets that the business needs. And that money goes in, it buys those assets. That helps the business become bigger. Therefore, the business is more valuable. The other side of that is it could be that somebody started their business. They've been very successful. They've been doing it for 20 years. They want to retire. They don't want to sell it to trade. They don't want to sell it to a competitor. What they want is the management team that they've brought in to run the business below them. They want to sell their business to that management team. And it could be that us putting our money into that business allows that founder to retire and the management team to take the business on. And that tends to be the two types of things that we're doing. How does private equity help aside from the money? YFM's got a portfolio of 56 investments today. I don't like the word experts. We're very experienced in helping smaller businesses increase value. So we're not going to come in and do selling for you. We're not going to go and bring you a customer book. We're not going to run your business. We wouldn't be sort of pretend we're smart enough to run your business. What we are able to do is provide strategic support, strategic challenge, bring the experience from the portfolio, bring the experience from other investments we've made to help and guide the management teams to deliver their plan. The bit sometimes I think people can get a bit mixed up is certainly at our end of the market, the smaller end of private equity. We're not buying anybody's business. We're supporting the management team to deliver their plan. So if ever we sit there and think we know better than management, that's probably the point at which we're getting it wrong. We're their management teams and founders come to us and say, here's my vision for the business. And we want to support them to deliver that vision.
Okay. And you talked about sort of bringing strategic expertise in and support. What does that look like in real terms?
Yeah, that is. So there's the question. Isn't it? Is the what exactly is it that you guys do? And it's so different in every scenario. But if I take it back to the broad basics, most smaller businesses are running really hard to grow, and really, really hard, and lots of jack of all trades, right? Because they tend to be quite efficient businesses. There's not a lot of excess intellectual capacity and workforce lying around because they're all really busy running the business. Private equity creates an environment that makes the smart people running those businesses stop and think about what they're doing a bit more. So in real terms, that means 10 board meetings a year and 2 strategy days a year. And those board meetings are all about saying, what's the longer term plan, the 3 to 5 year plan we've got to create value, and how are we doing on that value journey? All stuff that all entrepreneurs and founders are thinking about all the time, but they're probably thinking about it as they're going into work in the morning, and then reality hits them in the face, and then they think again the next morning that they need to think about the strategic plan. Having a third party investor involved creates the discipline and the headroom and the headspace that forces the smart people in the business to stop and think about all those things we've been doing all month. How is that helping us get to our journey? What do we need to do differently next month? What do we need to do differently next quarter? What could we be doing faster? What could we be doing slower? What's working? What's not working? Unfortunately, a bit of that is numbers. So I'm not an accountant by trade, but there is always going to be a little bit of looking back at numbers. We thought last month we were going to do X. We've actually done Y. Let's understand that a bit. How does that impact where we're going forward for the next year, 2 years?
Okay. And where does that strategic input come from? You say you're not an accountant. Obviously,
Yep.
You guys sit around and go, well, we'll invest in that, and that. Are these people who've worked in business before, or are they just number people? I mean, and I assume you've got a team of them.
Yeah.
That you will allocate to different investments depending what sectors they're in and expertise needed and that sort of thing.
Yeah, so what for YFM, we've got a team of 38 investment professionals across the business, and about half of those are finding new opportunities and investing in new things to us, and the other half is working with the businesses on the other side, so the portfolio stage. The people in our business, so firstly, they're a good cultural fit, so they're good people. I know that sounds silly, but we don't have, we're quite nice, and we like having people around us who are nice. So there's no masters of the universe at YFM. There's nobody who think that sort of city banker types. There's none of them. We're not really those types of people. So we're normal. And then there is a real mix of people who might have done private equity anywhere elsewhere. They might be accountants. They might have worked in businesses. But what they've all got is lots of experience of businesses growing faster, taking a step change to do something different, and the strategic challenges that come with that. So there's a bit of that experience. What they really are is a conduit to our wider network and our wider experience across the business, the portfolio, smart people we know who have done smart things. So if they're sat in a board meeting and the exec team are saying, this is a great opportunity for us to go and open a office in the US. Whereabouts in the US should you open a sales team? I don't actually know the answer to that question, but I could immediately think of 3 people that I would ring to say, when you opened your business in the US, when you opened up your US office, where did you open it up? Where worked? Where didn't work? Who's the great lawyer that you'd want to talk to about setting that up? Who's the great recruiter to find your salespeople? And that's the key skill, I think, of private equity, is matching other people's money and networks and people and businesses, and you bring those together in the right way, and you can create value.
Okay, so some of that expertise that you bring to the table is in-house, and some of it is just from your collective black books.
Yeah, so the strategic bit is in-house. The micro problem solving tends to be in our network. We do have a couple of people internally that we think of as in-house experts. So we've got a head of talent, and the head of talent works with businesses on their recruitment processes. So she's not a recruiter. She's not going to come in and find people for you. What she's going to do is help senior leaders think about how to recruit better. So how should you work with, who are the best recruiters? How should you work with them? Let's write a job spec. Let's write the best job spec. Let's think about bench strength. Let's think about how we're going to develop our talent pool. As businesses are growing, traditionally they're going to need to find more people. So we've got head of talent. We've got an ESG manager. So a lot of smaller businesses will do the right things anyway, because most people are good. What they're perhaps not as good at is making sure they're presenting all of that good stuff in the language that people want to see now. So the language of ESG. Our ESG manager, Finley, will work with businesses in our portfolio to help them make sure they're collecting the data the right way, they're presenting it the right way, they're using the right lingo, so that at the point everybody comes to exit the business and realize the investment, they're ticking all those great boxes for ESG, and 9 times out of 10 increasing the value because they're doing that. And then the third in-house talent, the third in-house expert we've got is a revenue operations manager. So quite new to us, but what Michael does is work with our portfolio in understanding their sales pipeline, understanding where they're winning, where they're losing, why they're winning, why they're losing, thinking about pricing, thinking about the most valuable channels for them to be marketing and selling through.
Okay.
They're the 3 things that we think we have quite expertise in.
I mean, all of this sounds wonderful. You've got all these experts, you've got this fantastic network, you've got all this strategic advice. What are the downsides for a private company taking private equity?
I mentioned earlier when we were talking, Phil, that I can be a bit skeptical of the financial world because because the media presents us as I used the phrase earlier today, masters of the universe, and we've all watched. Well, probably a lot of people haven't watched it, but sad people like me will have watched Wall Street. We've read all the books, we've seen all the financial scandals, the 2008 bad bankers, and people put us in this camp. So I don't think private equity is for everybody for their businesses, because not everybody really wants to go on the journey. So it is perfectly brilliant for somebody to own a business and be growing that business slowly and paying them and earning a lifestyle income and building good value, and that's brilliant for them. If that's what somebody wants to do, they probably shouldn't get private equity money, because that won't work for the private equity investors. So you'd be immediately starting misaligned. So that'd be the first thing. The second thing is if a business is being run by a team that are really in the weeds and really, really like doing the doing, really like being in the day-to-day of everything, and really, really focused on the nitty-gritty, then again, that could be a really successful business. But for private equity, that's probably going to be a challenge, because private equity is all about what's going to happen in the next 3 to 5 years rather than what happened yesterday and today. So the strategic aim of creating value, like big value, doesn't need to be hundreds of millions, but if you don't believe you can increase the value of your business by 3 times plus, over the next 5 years, you probably shouldn't take private equity money because you're going to be misaligned.
It's interesting, my business, we never took private equity, and we had a very, very successful, call it a lifestyle business, but it was a very successful business. And almost that desire to, put a couple of zeros on every figure and take it to that huge stage wasn't something I wanted to do. So it's you're right, it's not right for the right people. And how much of it also is people fear losing control as well? And one of the main reasons people start a business is so they don't have a boss.
Yeah.
Do you then become the boss? Is that one of the fears as well?
Yeah, there's only one boss in my life. That's my wife. But so that is a fear. That's a real fear. And the fear is because that's what people think private equity is, because that's the private equity world that's all mega big numbers. And they talk about private equity house is buying a business, because that's what's exciting for the Times to talk about. We don't buy businesses. We support management teams to buy their business or invest in their business. So whilst we do have, most private equity houses, including us, will have rights to protect the value. As long as people are aligned with the private equity house, then you don't have to worry about that, because we should all be going in the right journey. As long as they've picked the right private equity house who has a reputation for behaving well, not treating portfolio companies badly, and providing the support that they say they do, then that shouldn't be a problem either. And as long as it goes okay, then it will be okay. As long as the plan that private equity management teams come to us and say, we're going to do this, and we know that that's not what's going to, that it won't happen like this. It will be like this, and it might be like this, but it definitely won't be what they've said it's going to, what we all think it's going to be. Where people fear losing control is where the business underperforms the plan. And that can be a difficult time. But if you've picked the right private equity house who has a reputation for supporting businesses through that journey, then you're still going to be in control. It's if you've picked a private equity house that doesn't have that reputation, which all the time when I meet entrepreneurs and founders, private equity is different at every single house, and they've got to do more DD on the private equity firm they're taking money from.
Okay. I mean, that leads directly into my next question. How does a company look for and pick the right, you've said it a couple of times, the right private equity company? How do they do that?
It's a really weird thing. You'd be surprised how little time and thinking people do on choosing the right partner. So we talk about it as we partner with management teams. They bring the smart bits, and we bring the cash. Traditionally, people go and appoint an advisor, corporate finance advisor, probably investment. At our end, they're corporate finance advisors. Some of the big scary things, probably a bit more investment banker, accountants a bit. It's a small business. I want to raise some private equity. I'm going to go and talk to my local accountant. They're probably going to steer me towards a corporate finance team, a corporate finance person. That corporate finance person will know, or should know, who's the right funder for their business. So the type of the industry, the journey they want to go on, what they want the money for, where they're based, that should then present management with a selection, and then there'll be a process, and whoever offers the best money, the best terms, and convince everybody they're going to add the most support should win. And then what happens is then the deal happens. I think management teams and founders should spend a lot more time referencing the private equity house and getting to know them, and talking to their network, talking to people who are invested in people who are already in our portfolio, asking to talk to our investors, asking to talk to management teams that we've worked with before, management teams we're working with now. It's surprising how little diligence people do on us before they take our money. And that's fine, because we're great. But I say to management teams all the time, I meet them really early and I'll say, don't forget to reference us. And so many times when we're completing, I'll say to a team, how many references did you take on us? And they'll sort of shuffle around a bit and say, actually, I only spoke to one or two people, and they're the one or two people that you introduced us to. And I find it bizarre that it's such a big decision that people don't do more diligence on us, because we do loads of diligence on them before we invest.
Right. So they've got to do as much due diligence on you or alternative private equity houses as they have on you.
Yeah, yeah, and it's really simple things. So there's private equity like us who have committed funds from other people. There are other private equity houses who look and sound exactly like us. I have friends who work in some of these organizations, and they're what we call deal by deal. So they don't actually have any money. So what they're going to do is get you to agree to take investment from them. Then they're going to go and find the money from other people. And I don't think people ask that question. They don't ask where our money comes from enough. For us, it comes from pension funds and family offices and stuff. So we can articulate that really well. But the lack of due diligence management teams do on their private equity partner always surprises me.
Okay, that's interesting. I mean, anybody who's listening to the pod now and is thinking of private equity, if they don't listen to any other part of it, that's almost like the key bit is do your due diligence. But I suppose at the time, as a business, you're thinking, shit, we need the money. If they're going to put it on the table, we'll take it, without actually thinking, well, what's it going to look like a year down the line, 2 years down the line, et cetera, et cetera.
That is absolutely the point. That because 10 so I started at YFM 12 years ago. 10 years ago, private equity in the UK was relatively scarce. There wasn't as much of it. At the end of the market, we're at a £3 to £15 million investment size. There wasn't a huge number of private equity houses like us around. That the market of private equity houses now is absolutely exploded. There's so much more money looking to invest in UK businesses, and that's awesome. That's good for all of us. But the mindset has got to change. I think the mindset has to change from founders believing they're lucky to be getting an offer from private equity and actually doing it the other way around and go, well, they're the smart people who have built their businesses and created a load of value already, which is financiers. That's what we support, and we do all that good stuff. But we're financiers. We're not we're entrepreneurial, but we're not entrepreneurs. We haven't started businesses and done the brave stuff. So I do think that mindset shift should be more prevalent. It's not fair to say people should understand. I'm just surprised people don't realize that they're the ones with the power now. Management teams, good businesses have the power, not the funders.
Okay. You've mentioned you invest sort of £3 to £15 million. What size businesses are you looking at to invest that money in?
Yep, good question. So two types. So the growth capital, where we're putting money into the business, they tend to be probably loss-making, revenue generating, probably losing money, and we're putting money in to go faster. And at the small end, those businesses have probably got a dozen people in the business, 10 customers, probably doing the low end sort of $1 million, but we've done lower. So millions that we sort of anchor towards $1 million, but if we really like it, if there's lots to like, we'll go lower. All the way up to, so we've got one business doing 50 million of ARR. So it's not always revenue. It can be annualized recurring revenue. So it's a software business. I like to think that. So for those, we can go quite early, and they are 90% of the time, they're loss-making businesses. And then on the other side of our business, what we call the buyout side of our business, where we're buying a stake, either founders leaving and we're backing the management teams to buy their business, or the founder is selling a part of their business because they wanted most people who found, I'm sure you did the same, and you founded your business, 99.9% of your wealth is in the equity in that business. And quite a lot of people say, I'm still happy going on this journey. I'm still excited that I can improve the value by three times plus. But I would like to de-risk a bit and sell half of it today, bring in a partner like us. We can do the bits that we do to help accelerate that growth, but they get to de-risk a bit, pay off the mortgage, sort out school fees, all that sort of stuff. So for those businesses, they tend to be a bit more mature, probably making between 1 and 5 million of profit.
That's smaller businesses than I thought private equity looked at. I thought they were sort of 5 to 10 million upwards, that side of thing. So, anybody who's got a business, I mean, it's sort of the market I work in on my work as a business sounding board is that sort of size, your bottom end. So it's interesting. So anybody who's listening who's got a business, £1 million turnover, a dozen people, and wants to grow, you guys may well be the right place to go. But not you. I mean, YFM are brilliant, but any private equity house.
Yeah, and it's so we see about 1,600 opportunities a year, and we're trying to do a dozen or so. So we're meeting businesses all the time, and we're really happy to meet businesses to sort of explore, could it be right for they come and tell us the story, and they'll say, could it be right for us? And it might not be right for us, but we'll probably know somebody that it might be right for, or it might not be right for us today. So we then stay in touch. What can we do? Can we introduce you to helpful people? Can we add any value, even though we're not invested? Is there anything we can do to help? To the point that when the business is ready for funding, we're really well placed to help. And it's quite like any industry, it's a bit of a cottage industry. So I know lots of our competitors, smaller than us, bigger than us, do different things to us. So I'm always keen to help my chums in the industry. They're always keen to help us, and they'll show stuff to us that's too small for them or too big for them, and we'll do the other way around. So if you think that private equity is going to be on your business horizon in the next 3 years, start talking to people now. And obviously us, because we're awesome, but any sort of private equity house should be pleased to start to build that relationship early. If they're not pleased to start that relationship early, it probably tells you a little bit about them culturally. So yeah, if you're sat here with the business and you go, it's not probably quite big enough yet to go and raise some money, or I'm not ready to do a transaction yet, it doesn't mean you shouldn't be talking to the likes of us, getting to know us a bit.
Okay. You've just said you see 1,600 pictures a year. I'd like to ask you about what you look for in those pictures. But before we do, I need to tell our listeners and viewers about the Leeds Business Podcast Fair Deal. The Leeds Business Podcast Fair Deal has two sides to it. My side of it is I bring you educational, inspirational guests every week, free of charge, like Jamie. Your side of the deal, listener and viewer, has two parts to it. Part number one, recommend this podcast to one other person you feel will get benefit from it. Part number two, write a review on the Apple Podcast app or at podchaser.com. Make sure it's a 5-star review. I don't none of those rubbish 1-star reviews. So that's the Leeds Business Podcast Fair Deal. Fair deal, Jamie?
That sounds like a fair deal.
There you go. Fair deal. So you've got 1,600 pictures coming across your desk during a whole year. What do you look for when you're reviewing those applications?
Yeah, another great question that's not easy to answer. I'm a fan of. I like stories. I like, people buy stories, don't they? We know now. Everyone's all excited because the John Lewis Christmas advert's out. I'm genuinely excited, but waiting until I see my wife tonight so we watch it together, and that's a bit weird for a brand that I'm not sure would shop there a lot, but it's because they're great at storytelling, isn't it? And I would say that to founders and entrepreneurs, that it's all about how you're going to come and tell me the story. So an information memorandum or a pitch deck that's 250 pages long, full of loads of detail, loads of graphs, loads of pictures, awesome. You're giving away a lot of information really quickly. Not sure you'd want to be doing that. Versus a 20 to 30 page pitch deck that gives the story, gives enough information to get interested. That for me, it's all about how are they articulating the value, and then I don't want this to sound negative, but what's the company's reason to exist? And I don't mean the sort of big bold social statement. I just mean, why should this business exist? Does anybody care if this business isn't here tomorrow? I think people who get that across well will immediately grab my attention, and then it always comes down to market and management. And it's always we've done really well in investments where the market has not turned out to be as good as we thought it was, but the management team have turned out to be better. So we've all still made money, and likewise is reverse. A great market won't make up for a management team that can't deliver.
Okay. I do a bit of angel investing. It sounds very similar to an angel investment pitch. It's what's the pain point you're solving? Why are you a better solution than anybody else? How can you guarantee that you're going to deliver? And then we've got the hockey stick graph at the end, which we know is a load of nonsense because it's never going to deliver like that anyway. But everybody likes it.
So you're right, and I do, and it's really hard because I have a lot of sympathy because management teams will say to me, "Well, I know, but if I didn't put that in, you wouldn't think I was ambitious." And you're like, "They're absolutely right." One of the sniff tests for me is, have I had to go on their website to work out what they do? And you'd be surprised how many times I can read a beautifully prepared pitch from a corporate finance advisor, and I get to the end of it and I go, "Brilliant! Let me just log on to work out what it is they do," because it gets lost. It gets lost in the hyperbole of it's the greatest thing in all time in any market. And I sort of go, well, what I really want to know is how they make money or how they're going to make money in the future.
Yeah. So it's almost, yes, you want them to show off and tell you how wonderful they're going to be, but it still needs to be the basics of this is what we do. This is how we make money. These are our customers. This is the market we're in. And this is where the growth is going to look like.
Yeah. Yeah, absolutely.
Yeah. So you've talked about, places where you've made money with either great management teams or great markets. Go on. You've got the opportunities now to show off. What's your best success story?
Oh, wow.
But there is a caveat. There is a caveat in that question, is that there's another question afterwards, and you can guess what the second question is going to be.
I can already guess what the question is. So what's the definition of success is my rather glib, because there's business. So I'm a sucker for a person. So seeing people do well, I want the funds to do money, right? The investors are our customers, and that's number one job is to make our investors great money. But leaving behind a business that's better than it was before we were involved is the thing that sort of gets my juices. That gets me all happy. Or having a result despite what happened, that makes me happy. So there's lots of those. The best financial return that I've had recently, it was a business called RGE, which we exited earlier this year for a very, very, so we invested in that business when it had 40 people and was making $1 million or $2 million. And we sold with the management team that we backed, sold at the same time as us. And that business was 6 times bigger by the time we exited. So number one, great. It did fire and electrical safety for social housing, which is doing a good thing. It recruited a load of people, so it's good for employment. It generated a load of cash, which is good for us, good for the management team. And that business has now gone on with another private equity investor. The management team we backed wanted to come out with us. And they're going on doing other things. New management team that's in there, going on with a new, much bigger private equity house on an even bigger journey to make that business will be sort of multiple times bigger by the time they come to exit. So great financial return. That's good for our investors. That's good for me personally. But great. It feels good to know that there is a business that might not have achieved what it achieved without us being involved.
Okay. So the next question then, what's the worst one?
So we were invested in a business. So we completed it. So both of these deals actually were completed during COVID. So that first one was towards the end of COVID, and the one I'm about to talk about was earlier in the COVID journey. And we backed. They were a conduit within a market. So I'm trying to be a bit opaque here. There was a conduit within a market. So what they were relying on was volumes of things that happened in a market. And then there was a few macro events outside of the control of that management team. And it just whacked the business sideways pretty much every quarter. Something bad happened. And that is soul destroying for us. Soul destroying, that's the wrong word, isn't it? It's value destroying for us, but it's soul destroying for the people who it didn't matter what they did. They were just getting punched in the face every day. And that business doesn't exist anymore. So that business went into administration because the market just so fundamentally changed quite quickly as well within a couple of years. So it's always bad to we don't lose any money. It's part of the job. That's what happens sometimes. But it was more just the impact on the people getting up every day and going into work and getting punched in the face and knowing that there's every chance that's not getting better anytime soon. And it is interesting because we're a couple of years away from that, a couple of years down the line from that happening, and that market has continued to get worse and worse and worse. And there is obviously, if we lose money, we go back and do a review and what we learn, and nothing we would have done differently if we had the time again. We would not have thought, hindsight, obviously we would do lots of things differently, but if we had the same information, we'd have done it again, because nobody would have foresaw the two specific macro events that happened that just wiped out that business. And it's sad. It's really, really sad. And I'm most sad for the team that put 10 years into it, sort of come out the other end was nothing. That's schooling.
Yeah, I mean, if it's a macro event and there are multiple macro events, you can't affect those. Yes, you can pivot and change and try and change strategy and try and change what you're delivering. But if the market changes that fundamentally, that you are wrong place, wrong time, wrong product, there's not a great deal you can do. And that is the nature of business, whether it's private equity backed or just an individual. Just unfortunately one of those things that happens in the risky world of running your own business.
Yeah. And I one of my many, and I won't go off track here, but one of my many frustrations is how quick the society and the media is to beat up on business owners when something goes bad. And I was talking to a journalist from a broadsheet a couple of weeks ago, and I asked, I was quite accusatory and sort of said, look, you don't want to hear good, you haven't rung me up to talk about good things. You've rung me up to get me to give you a quote about something bad. And I was like, why? Like, why can't we just talk about all the amazing businesses that are out there that are doing great things, rather than focusing on the one yesterday that has had some bad results and you think for some reason I'll have a view on it? She's like, well, it's really simple, Jamie. Bad news gets 8 times as many clicks as good news.
It's always been the case, hasn't it?
Yeah, it's a societal problem, isn't it? We should all just be more. I just wish people were happier to celebrate success of others. Unfortunately, the green-eyed monster tends to kick in, doesn't it? And we're not out there celebrating when somebody gets hundreds of millions from creating a business. We're sort of sitting there going, grumble, grumble.
Yeah. I mean, my previous business was in the online gaming space, and every year, annually, the woman who heads up Bet365 gets hammered because of how big her dividend is. But she's UK based. She's the biggest employer in Stoke. She pays her taxes. She's a huge benefit to GB UK, but she gets hammered every year because she takes big dividends, and it just doesn't make any sense at all.
And whilst that lady did inherit that business, she built it to what it is.
Oh, absolutely.
Why doesn't she deserve the success? So I agree with that. It's funny you use that as an example, because it just shake my head. But the other one for me was when Darktrace got sold. When Darktrace got sold to the US private equity house, and the headline was another fantastic UK business sold before its prime. I was like, imagine if the headline had been a fantastic UK-based business started 10 years ago, sells for £4 billion. What a great result for everybody involved. It's exactly the same story. Yeah. But rather than it being negative that it's been sold to a US PE house, we should be positive about I can't remember the lady's name, but what an awesome job she did in creating this massive global leader in cyber.
Yeah. No, Denise Coates is the woman. Peter was her dad. He set up the business originally.
Yeah.
Okay, so we've spent quite a long time talking about private equity. This week's how-to, and every week we ask a guest to give us a how-to. You're going to give us a quick lesson on how to find the right type of investor, and the answer isn't always private equity. So, Jamie, take it away.
If you need investment for your business, I would start by looking at businesses that look and feel a bit like mine and finding where they got it. And that there's a bit of Google in that, but we all know who our competitors are. So go and have a look at your competitors and see who invested in those, see when they invested in those, what that money looked like. Private equity, did they float on the stock exchange? Did they raise money from angels? Did they get a bank loan? So it's a bit of digging, and then ring the CEO and ask them how it's gone. Because I don't think anybody's open enough to asking for advice. So I ring people, I message people on LinkedIn all the time and say, I've got a thing that I think you could help me with. Would you mind if we just had a quick call? And 50% of the time, people come back to me and say, yeah, I'd love that. Who doesn't want to be asked for advice? So I would strongly suggest people go and start by finding somebody who looks and sounds a business that looks and sounds a bit like yours, and then work out if they got funding. And they just ring them and ask. It's probably LinkedIn with them, and then ring them and ask rather than just cold calling them. But if you go and find lots of intermediaries in our world, and loads of them are brilliant, but it's the vested interest piece, isn't it? So what's the best outcome for your business might not be the best outcome for the advisor you go and talk to. Whereas if you go to a non-interested party, a competitor, a supplier, a customer, and you say, I want to do something like you've done. Can I just talk to you about how you did it, who did it, what worked, what didn't work, and build your own knowledge base before you go and talk to the experts. Because once you go and talk to the experts, and there's loads of them that are absolutely fantastic, but once you go talk to them, you're sort of it's good to get their advice, but I would start by doing some self-learning before we get that far.
Yeah, that's really good. That's really good. And almost from a food chain point of view, it's, you start with friends, family and fools, then it's angel investment, then might be a bank loans in there somewhere, then it might be private equity, then it might be VC, then it might be bigger pots from there. And it's that food, it's almost like that food chain of where you think you should be before you decide which one you're going to go after.
Yeah. And what do I want? Do I want done money? Do I just want money from someone? Or do I want money from people who think they can help? And if they think they can help, you probably should do a little bit more research just to make sure that they can.
Which goes back to your DD on private equity. So you do DD on the private equity, you might do DD on the angels.
Yeah.
You get DD on the bank. They might call your loan in straight away, and then you're stuffed. So
yeah, and there is loads of money out there. And I know I say this, and then I'll get lots of messages from people saying, "Oh, you say there's loads of money. Where do I find it?" Good and great businesses run by good and great people will find money, because there's huge industries of people like me trying to do it, and you as an angel investor trying to get your money into great businesses to work and generate a return. So yeah, I would take your time in doing the research to find the right person.
Okay, great advice. Actually, one question that falls out the back of that: do you ever go chasing businesses? Do you ever go sort of waving your checkbook at businesses and go, "Hey, you've ever considered us?"
Yeah, well, so I've got we've got a deal origination team, led by Tiffany, who joined us a few years ago. She's awesome. So Tiffany, Frankie, and Adam, they are doing that all the time. So they are, I should know this, but I think they reach out to 100 businesses a month or something like that for a chat, but not in a do you want some money? Can we buy this? Can we do this? Can we do that? The other. It's more like, you're actually doing something that looks really interesting. Can we have a conversation? It might be that private equity is not for you now, but can we have a conversation to see whether or not private equity can fit into your ecosystem, fit into your plans? A lot of the transactions that Tiffany and her team find are businesses that we've been talking to for a couple of years before they want the money, because we've got to know them, they've got to know us, we've done all the referencing, they've referenced us, we're all happy. We've maybe helped them a bit on the journey, we might have been able to make an intro or two that's been helpful. That means then when they do want the money, we're really well placed to help.
That's interesting. I suppose it makes logical sense, but I always thought it was the businesses coming to you sort of cap in hand rather than you metaphorically waving checkbooks at people. So it's really interesting.
It's this switch of supply and demand that we touched on earlier, isn't it? That actually there's a lot of money out there now. So for us to find good and great businesses to invest in is tough. It's a challenge. It's a fun challenge. It's a remunerative challenge, but it is a challenge.
Great stuff. That's great. Jamie, thank you so much. It's been really, really educational. I hope the listeners and viewers have found it educational. And from a personal point of view, thank you for sponsoring the podcast. And as I said at the start, you can find more about YFM with a link in the show notes. Jamie, thank you very much.
Awesome. Thanks, Phil.
I hope that you enjoyed this episode. Make sure you hit the follow button so every new episode gets sent straight to your phone.